Well, let's kick off. We've got a lot to get through in this session. So good morning, everyone. This is a big hall. If you want to get closer, please do. We're going to be today talking about venture debt and how it can help startups in their growth plans. Probably to start with, just to introduce myself, John Bailey. I'm with the state government, Victoria, and we've participated a lot in venture debt. We have been a cornerstone investor to set up a venture debt fund called the Venture Growth Fund. We have two managers for that. One is One Ventures, and the other one is Lighter Capital. Also, one of our sister organisations, LaunchVic, has supported Tractor Ventures, and we have Tractor Ventures here today as well. So with venture debt, we're going to take it apart. We're going to talk about the what, the how, and the when. As I said, we're going to leave some time at the end for some questions. We have a good panel of practitioners here, venture debt practitioners here, and I'll go from the far end. We have Ian Gardner, who is he's a partner at Gelix Ventures, but also a market development director person for Lighter Capital, so involved with Lighter Capital. Next is Jody Imam, and so Jody is co-founder and COO for Tractor Ventures. And next is Justine Casino, who's a director for One Ventures. So maybe I think how we should start this off is really just go along the line, and for each of you to have an opportunity to talk about your business, what areas you focus in. I think one of the real issues with venture capital is it lends itself to too much generalisation or overgeneralisation. So there's different parts of the market that people are involved in. So maybe I'll start off with Justine first. If you just want to introduce yourself and One Ventures, etc., and your area of focus.
Yeah, thanks, John. So like John said, I'm an investment director at One Ventures. At the moment, One Ventures has two active venture debt funds, one of which is our Victorian Venture Growth Fund alongside Invest Victoria. And we typically invest in businesses from around about Series A onwards. Our minimum loan size is $1 million, and our largest loan size was $20 million that we did alongside our partners in Israel, Viola Credit. In terms of our strategy, we really are kind of multi-strategy tech, and so our existing investee companies span from everywhere from aviation and space technology all the way through to digital consumer health.
And Jody, next.
Thank you. So at Tractor Ventures, we exist to unlock possibilities for founders. We like to talk about rockets and tractors, and the rocket is the symbolisation of the VC model, which, rockets are very exciting and some of them land on the moon, but a lot of them blow up along the way. Whereas tractors we're finding equally as ambitious, but more sustainable, hardworking. If you said to the farmer, I'm sorry, we're going to take away your tractor, she or he's most likely going to be pretty upset. So we're starting with revenue-based finance and also advice for founders, so that for technology companies. So that can be, it's completely industry agnostic, so across all industries. We've supported 50 companies so far in our 18 months. And yeah, our check sizes are from between 50,000 and 1.2 million at the moment. It's growing bigger as we go on. What else can I tell you? So yeah, we've started with revenue-based finance, which is effectively a loan against future revenue. It's very flexible, and so you pay back as a percentage of your revenue, so then the repayments float as your revenue floats as well. It's also unsecured lending, so it's very flexible for founders.
And Ian, please.
Okay, welcome. I wear two hats, so I am a VC, a little bit like Justine. I'm a VC with Gelix Ventures, but we also love debt, and they're not competitive, we don't think. Lighter has been around since 2010, headquartered in the US. It's done 1,000 loans, deployed about 250 million over its lifespan. Very similar to Tractor in terms of the focus and the practicality of it. So revenue-based finance, some term loans, and yeah, typical check size is anywhere from 50,000 all the way up to 4 million if the stars align. It's been active in Australia for a couple of years now, and yeah, no, it's very accretive and symbiotic, I think, with the venture world, the debt world.
So maybe just to talk about the current environment at the moment. So we've seen equity valuations to be very volatile. It appears to be a good market for venture debt to extend that cash runway. But maybe just a few comments about where venture debt is at the moment and the outlook for it going forward. And maybe, Ian, I'm going to say you have the microphone, you all do, but anyway,
yeah, sure.
You have a go first.
So, I mean, I'll maybe just touch on that macro environment. The thing that's been clobbered in the current environment is the late stage businesses in particular. So the closer you get to the public market, the more you're getting affected. Where we play, most of us on stage here, is at that pre-seed and seed stage. I think I read a report the other day that was suggesting that there's actually been no change in valuation at the seed and pre-seed level. Gelix, for example, is a 10-year fund. 10 years from now, the economic cycle will be different. It's actually a really good time to invest. And I think that is cascading through to the venture debt world as well. It's a sophisticated environment that we're in now. So founders are fantastic. Most of the ones we're talking to have got really good, sticky, recurring income. Australia is very strong in that B2B SaaS, which is perfect for venture debt. And it's fairly new, I think, for all of us on stage here. So the trajectory is still up and to the right is kind of the punchline that we're seeing. So rumors of the demise in this sector are grossly exaggerated if you're hearing them. So it's pretty good.
Jody or just Andy, do you want to make any comments to that?
Yeah, absolutely agree. I think it's a positive environment, and we've seen, like for us, it's been tailwinds. I mean, everyone getting nervous about their valuations has caused founders to call in, and really, I've noticed, having spoken to about 400 founders since we launched last year, that they've definitely gone from curious to serious now about venture debt, and really, how can they use different sources of capital to grow their company, not just that one option. So. Yeah, I think there's lots of positive momentum.
And Justine, can I put a spin on my question to
Sure.
you on the same subject and that? But just looking at like those mature markets like in the US and the size of it as a percentage of VC fundraising. So, and what we are like here at the moment, and it's a developing market and it's got a lot of headroom. But maybe just to talk about how large the US market is and how large it is in Australia and where it could head to.
Yeah, well, obviously, venture debt features a lot more prominently in the startup and scale-up industry in the US than it does in Australia. But I really do think that that's probably just symptomatic of the fact of how quickly the VC and startup ecosystem has grown in Australia over the past 5 to 10 years. And I think the venture debt sector will just grow proportionate to that. I do think, perhaps Australians maybe are a little bit more on the conservative side about debt in general and tend to be, compared to our US and EU counterparts, perhaps a bit more concerned about leveraging up too much. But I think it's all about education at the end of the day. Once people become a little bit more educated around the difference between the types of debt financing that you can get and how, all of us, we're all venture debt providers and we are very, very different from a big bank. And we operate and behave very differently. So I think once we can get that message out there, people will kind of generally start to become a little bit more comfortable about incorporating debt into their capital stack.
Interesting. I just saw recently about some of the sizes of the debt raises for startups in the US. They're about $1 billion size. So, it's a very large market. I think one of the real advantages of venture debt is how it's non-dilutive. And just that whole, position for startups that you don't have to give away a stake. So maybe, Jody, do you want to just have a kind of response to that and one of the benefits of venture debt?
Yeah, thank you. It's the whole reason, we exist. We want to be able to provide founders this option where they don't have to sell parts of their company. And often, especially at our early stage, you're selling quite a big chunk usually for not very much money. We compare, like if you were to compare that as an interest rate, selling your shares really early, investors expect a big return over time. So at a pre-seed stage, we've worked out, it sort of works out to be about 400% interest is what you're paying. So sometimes founders think that it doesn't cost them anything because it's not cash they're paying right now, but it actually, over the long term, it costs a lot. And the other thing is, once you've sold those shares, you can't get them back, really. Like you can, but it's really hard. So, that's where using debt, especially in the early stages, is a really smart way to look at capital for your company over time.
Justine, Ian, want to comment on that?
I could definitely add to that and probably go even further to say that at the end of the day, equity multiples and valuations are impacted by a whole range of things. Obviously, at its core, your tech and business model, but your size and how fast you're growing as well. And both of those things can be optimized with the use of debt. So it just means that not only are you giving away more equity than you have to at this point in time, but if you can utilize some debt in your capital stack, you can effectively raise at potentially a much more favorable valuation and dilute yourself even less in future. So something to think about in terms of the timing of when you want to strike that equity raise in future if you do choose to do so.
Yeah, I've seen some interesting case studies that you've presented on that, which is quite interesting how much money can be given back to the founder.
Yeah, but ultimately, if you're a startup that's considering either debt or venture or a combination, the reason you're doing it is to grow faster, and the reason you're doing that is because you're ambitious. You don't want to get steamrolled by your competition. So ultimately, the outcome from that should be a much more valuable company. So as a shareholder in that, whether you're the founder or the venture capitalist behind it, more money into that business in any form is going to help those shareholders. So this is why I think this is such a great instrument, venture debt, because it is building that wealth within the company for the shareholders, including the venture capitalists too. So everyone benefits. I think it's really good. I think it's going to become much more common in the future. It may not be well known now, but in 5-10 years' time, it's going to be pretty much default.
It also speaks to that issue about the difference of cost of equity versus cost of debt. Most people think that not most people, but people do think that equity is free and debt's expensive. But I think that's a kind of an important distinction. But does anyone want to maybe make a comment about that?
I think it's probably the case because returns for debt providers are visible. And so perhaps that's why it seems to be more expensive when actually it's not. At the end of the day, debt sits higher on the capital stack than equity, so it should always be cheaper than equity. It's just that, our returns come along the way, and like I said, they're more visible than what equity returns are. So I think that's probably what leads to that misconception.
Maybe just to move on to some kind of real transactional kind of issues and around the documentation. How long does it take if you wanted to do a venture debt transaction? How long does it usually take from start to end?
Well, for us, from the time we first meet a founder, we can have money in the bank within 2 weeks. So it's much quicker.
Yeah,
which
it's
is
pretty
a real
similar.
advantage.
2 to 3 weeks is at the sharp end. I guess average is probably 4 or 5.
Yeah. Justine, about the same?
Yep, pretty much exactly what Ian said.
And is documentation relatively standard? Is it is it fairly standardised, and is that one of the reasons why it's so quick to transact?
Jodie's the operational guru at Tractor, and I know your processes are pretty fantastic, but Lighter has built its own DD transaction engine that sits behind it, and it's pretty sophisticated, and it's as you'd expect. You need to submit your financials, and you need to get a pretty clear understanding of where your money is, where it's coming from, fairly standard stuff, but once you've opened access to your MyOB or Xero account, then it becomes much, much simpler. So it is pretty standardized, and it is quite process-driven.
Just the use of warrants in venture debt. Maybe, Justine, might be a bit more applicable to yourself, but just to talk about how warrants are used in venture debt.
Yeah, sure. Well, I mean, it's a really good case study because I think we all have different approaches to this. One Ventures, the terms typically involve an interest rate and warrants that attach to the debt. The way we view warrants is it effectively gives us a long-term interest in the business. That can be actually pretty handy during downtimes, including during COVID, or in situations where it can be really difficult to raise capital for some startups, including the current market. What it means is that we're effectively not thinking only with our lender hat on, because some of our return is tied up in the long-term success of that business. So we just find it's really helpful in terms of the type of support we can provide to our businesses during challenging times, because we do think, a little bit more long-term, and we're invested in that eventual success of the business.
Anyone else want to make a comment on that?
I definitely agree with that. We like the phrase, we're here for the long time, not the loan term, and that's very much where the warrants come in. We've actually split out our warrant part of what we do, so our loan agreement is strictly just the loan, and then our warrants are tied to our advisory, and so we've got a huge, village of investors and ex-founders and experts in growing global companies that we can access for our investees, and so that's optional. So if they want to give us some warrants, we'll agree to pay for the warrants and earn them. But if we do that, then that's very much tied to the advisory services that we offer.
I've got a very simple answer. Lighter does not take warrants. It's just, so there is no venture in the venture debt component. It's just debt.
And is that a deliberate strategy? I mean, is that your business model, as I should say?
Yeah, I think so. Look, I wasn't involved in that strategic decision, so I can't really comment too much on it. I mean, I think it's sensible. It's not that you have to be one or the other. One Ventures is a good example. They're a VC as well as a debt provider. But I think it's just clearer. If you talk about the, money without dilution, warrants is a form of dilution. So without that, I think it's just clear.
So we never want to get to this stage, but what happens if things go bad? I mean, what do you do in those situations? So maybe Jodie, I'll start you off with that question first.
Thanks. I've got a great story I love to tell. In one of our companies that we loaned, actually one of our very first loans, they got into a bit of trouble with their cash flow about a year in, and they came to us and wanted another loan, and we assessed the state of the business, and we realised that if we gave them another loan, it might even sink them. So we said, we can't give you another loan, but what we'll do is help you find the right equity investor to give you the cash injection you need right now, which we did, and now they're really on the up again. So it's always going to be in our interest to help the founder unlock the right capital for the part of the journey that they're in.
Does anyone else want to make a comment on that?
I think that's a great answer. I mean, that's the way that any lender or any venture capitalists, like one of the key things they can do is to provide introductions. So, I mean, that's awesome. Look, one of the great things about revenue-based finance is when cash flow is tight, you're not calling the loan. So Lighter doesn't have a minimum repayment. So if you literally are receiving no money in a certain month, there's going to be no requirement to pay anything in that month. So it kind of levels itself out within the terms of that loan.
Yeah, I mean, the only thing I'd add is that we've obviously been through one of the most challenging market environments over the past couple of years. We have, businesses in our portfolio who were, very obviously decimated during COVID, and nothing's gone nuclear yet. We've been able to support them throughout the whole process, and now they're posting the largest numbers that they've ever had. So, in short, there's definitely things we can do to support them during those times.
Just going forward, just looking at the evolution of venture debt and what it could be used for, working capital lines, committed lines, and so forth. But maybe a comment about how do you think it could evolve and what could be the drivers for the market going forward. Ian, did you want to have a shot at that, or we'll pass it down the line as well?
I doubt you're going to see it evolve to the point that you're getting shareholders bought out with it. So I think that's a use that it won't be. It's really just that working capital. The money's coming into the business to accelerate the growth of the business. So it's really to hire staff. I don't think you will not be seeing it, I don't think, used for getting cash off the table as a founder. There's other mechanisms for that. Look, I think it's just going to remain the same, to be honest. I mean, the cash is coming in to accelerate the growth in the business, which really in the SaaS software space, which is where most of us play, salaries. So that's I think, I don't think there's going to be much change.
Just go down the line if...
Yeah,
sorry, Jody, before you start there, we'll ask some questions of the audience very soon, so get your hands ready.
Yeah, I'll just add to that. Like the use cases that we're seeing for revenue-based finance is, it's really that short ROI kind of stuff. So if you've got an advertising sort of campaign or an acquisition strategy that's working, and if you put $1 in, $4 is going to spit out, then that's exactly the sort of use case you want to use this money for, as opposed to hiring engineering teams that are building longer-term product. That's where you really probably want to look at equity capital. So it's that shorter ROI stuff.
Yeah, I'd agree with that. I mean, maybe with a slightly larger loan size as well, we tend to look at overseas expansion opportunities as well. It is a little bit more uncertain, but it is a common theme at the moment. By and large, we're seeing pretty much just extension of runway at the current time. I'd love to see more acquisition financing. It's a bit of a wild card in the venture debt space, but in the current valuation environment, I think could be some good opportunities there.
And committed lines, is that something which is evolving?
Yeah, I mean, it's always been an option, so for sure.
I've got a couple of final questions here, but maybe just to the floor. If anyone's out there wanting to ask a question, please put your hand up. I was told by Ian the first one's the most difficult one.
There's one down in the front here, Stu. Get your trainers on.
I need to start up with a hoverboard. Hi. So I'm from the UK, as you might be able to detect, and their venture debt doesn't tend to be used right at the start. Definitely tend to kind of follow on from an equity round once you've got a bit of traction going. But it sounds, certainly from what you were saying, Jody, that perhaps in Australia that's a bit different and people can use it right at the start of the venture. So just interested on kind of how that works.
Yeah, great question, actually, because I would say it's not really right at the start, because the companies, especially for us and for Lida, well, I guess all of us, there needs to be revenue. So there already has to be, for us, at least $15,000 a month in revenue. So it's not right at the start, but it certainly can be early. We do have a lot of our companies as well that have taken some initial angel funding or family and friends cash already, but yeah, it's early in the revenue journey.
Maybe a quick comment on that. Australia is very heavy in B2B SaaS. I mean, that's our specialty. We don't have too many consumer businesses, and that's tougher for venture debt to participate in anyway. So I don't know whether there's a slight difference there. I don't know enough about the UK despite my accent.
Any other questions out there?
Just talk amongst yourselves.
Hi, everyone. Just a quick question around venture debt and allowing sort of founders to get senior finance in future. Does that help with credit worthiness for companies who are scaling up and so forth?
You mean from an equity investment perspective or what?
Well, does venture debt sort of bridge them in terms of getting or securing senior finance in future? And does that sort of allow them to get longer term finance in the future?
Does anyone want to answer that?
I'm looking at Justine. But.
Yeah, I mean, we haven't experienced any tension around that. I think all of us are in a situation where you're free to repay the loan as you like, alongside the terms of the loan agreement. So it really shouldn't impact it at all. If anything, it means that you've already gone through the DD of a lender. So.
Yeah, I mean, experience is quite good when you're trying to do these things, and people are a lot more comfortable going forward. Other questions there before I go into the final ones? We've got one right at the back there.
Yeah, thank you very much. everyone. It's been really informative. To bridge the gap between startup where you don't have the revenue metrics to meet a debt position, what would you recommend? There's obviously pre-seed and seed. There's safe notes that seem to be talked about a lot more now. What are your preferences to get you to that revenue phase where a debt option is more attractive or possible?
Probably Ian or Jody for that one.
I mean, look, you're at really early stage. Is that where you're at? Look, the reality is it's really hard. I mean, crossing that chasm from not having anything, so you need money to get your business off the ground, but you can't get your money because you don't have your business off the ground. The answer is hustle and favors. So you kind of get goodwill with your friends, your family, normally once in your life. Now is the time to use it. Call in those favors, pull out your credit card. I wouldn't necessarily recommend taking a loan against your house, but if you've got nothing else, you got to demonstrate that you can actually build the product and the company and demonstrate some form of traction. Sometimes that's revenue. If you're looking for venture debt, it would have to be revenue, but in other businesses, if you're looking for equity investment, there may be other metrics that count. But that first phase is all about hustle.
I think there's one question down the back there.
Just on the sort of risk-reward spectrum, I guess this is obviously the sort of higher end of the risk spectrum, but can you talk to general kind of rate costs around this? I mean, many founders look at sort of putting stuff on the credit card, which you kind of think is your sort of upper bound of what debt might cost. Are you sort of below that, above that, around that sort of number?
I think all three of you have probably answered that one.
Well, I think credit card is a good analogy. It's kind of that credit card sort of interest rate. That's how, I guess, it's hard because you don't know what's going to happen with the revenue. You don't know how long the loan's going to take to pay off, so you don't actually know what the effective interest rate is. But you could think of it as that sort of credit card, point.
Yeah, mid to high teens, depending on the risk profile and the way, and it can be lower, it can be slightly higher.
And then, One Venture's in a bit of a different boat because we're a bit later stage, so it's kind of low double digits.
Okay. So I'm going to the last question from the panel here, or my last question, but is anyone else in the audience? If not, then maybe just a closing comment from everyone, just about any advice you would give for a startup, and we've been touching on a bit of it already, any advice for startups in the next 12 to 18 months. What should they do to get themselves prepared for a potential a venture debt transaction? So maybe, Justine, I'll start with yourself.
Sure. Well, as a start, I'd definitely encourage founders to be really thoughtful about their blended cost of capital. I think, I see a lot of founders just go default down the equity raise route, and while that can be, venture debt isn't for everyone, so that can be appropriate for some types of businesses. I do think that there's a lot of missed opportunity to overall lower their dilution and the amount of pie that they get when they eventually do exit at the end of the day. So yeah, I'd just love to see founders be a little bit more thoughtful, maybe think about getting a couple of venture debt term sheets to compare. And it's also not binary, right? You can also raise, if you're thinking of doing a $10 million raise, you can do 5 with equity, 5 with debt, with 2 really, really reputable firms, and have potentially more optimal outcome for yourself. So I'd have a think about that. I'd also have a think about any really large expansion opportunities available. Think about what that ROI is and whether it could be more profitably funded with debt which has a lower cost of capital.
Yeah, great.
Yeah,
Sure.
100% agree. And I think we like talking to founders early on, even before they have revenue or before they have our minimum revenue. And it's just knowing your options. That's the key thing, knowing your options and asking for help. Like, there's a lot of people who've gone down this path before you, and they're happy to help. So I think it's just, really reaching out and laying out all your options, and not thinking about debt as a dirty word, or associating it with childhood memories of debt or whatever, or the credit card buying the LCD TV. It's more like, what is the most effective use of capital, and what's the best way to leverage the capital that you can get to grow your business.
Yeah, and debt providers like us like sticky, recurring, high-margin revenue. So, as you're growing, sometimes you'll be, to my hustle answer before, you might be reliant on some services income. But ultimately, to get venture debt, that's going to translate over into product income. So that's really what you'd focus on. You know, how can you go from service-based income, or more, if you have that, like transition over to that product-based income.
I think we're just about to close up, but any final comments from the panelists there?
Look, I think we'll all be around all day, so come and grab us at the breaks.
Look, I'd make one last pitch. As I said at the very beginning, the Victorian Government is really a believer of venture debt. We've stepped in with a number of the venture debt providers and are working with them to try and develop the market. Not only are we doing venture debt, but we're also looking at doing setting up equity funds as well. So we're very active. The government is a very big believer that startups is where job creation and economic growth comes from. So they understand risk and they understand rewards. And so you will find the government out there partnering. We don't know the industry, we partner as we have, but very much partner in the market as well. So with that, I'd like to just close it. I think we're right on time.
Nailed it.
We're not.
I said you nailed it.
Nailed it. So just to thank Ian, Jodie and Justine, thank you very much, and to the audience
Thanks,
as well.
John.
And thank you to John
you.
too.